Good morning, good afternoon, everyone. We're at the top of the hour. We see everybody getting off their team meetings from the half hour before and jumping on. So we'll give it another 15 seconds or so before we get started. Okay, I think we're a minute past the hour, so we'll go ahead and get started. Again, good morning, good afternoon, everyone. Thank you for joining this webinar talking about commercial real estate valuations in the US. It's a very popular topic right now, so we thought it'd be good to get a few of the experts in the valuation process together just to talk a little bit about what the commercial real estate valuation process is in the private real estate space, and about some of the challenges that we're going through in these uncertain times. But before I introduce everyone, before we get started, let's go through a couple of housekeeping items. This session will be recorded, and you'll be able to watch it later. And so we've automatically muted everyone that has joined. But you are able to submit questions and comments in the Q&A function. We'll kind of monitor those questions on the side. We'll try and incorporate those questions into the questions that I'll be giving to our panelists. But if we don't get to, we likely won't get to all the questions. If we haven't gotten to yours, we'll definitely follow up with a response afterwards. So with that, I'd like to introduce our esteemed panelists here. I will say, very relevant in terms of expertise. Each of the panelists, as well as myself, has at least 20 to 30 years of valuation experience. Everybody's an MAI and CRE on this panel, so very relevant experience for what we'll be talking about today. First of all, representing as the appraiser, we have David Walden. He's the managing principal of National Property Valuation Advisors in Chicago, where they complete over 3,000 valuations each year for both equity investors and lenders on assets totaling over $250 billion in gross asset value. From the auditor perspective, we have Nathan Florio. He is principal with Deloitte's Risk and Financial Advisory Practice. He's based in New York City, and he's the lead advisory partner for many of Deloitte's largest public and non-traded REIT and real estate fund clients across the US. And then finally, we have Robbie Tanjung. He is representing not only the valuer, appraiser, but also as the valuation advisor role. And he is with Altus Group in Chicago. He heads up the Global Advisory Services, where he leads a team that manages the valuation process on over 15,000 assets each quarter, totaling over $1 trillion in gross asset value. And then myself, Rick Calvoda. I'm based in Irvine, California, with Altus Group, where I'm the president of Altus Analytics for the Americas. Again, thank you guys for joining. And before I throw some questions at you about the valuation process, just walk through a couple of slides, because I think a lot of during these uncertain times, where there's uncertainty and not as much clarity in valuations, a lot of the questions come up, and a lot of questions we get is around what the public markets are saying for the REITs, and then what the private markets are saying for the valuations. And this just shows a slide just showing the difference between the gap between public and private valuations, or rather quarterly returns. And you look at this since back in the late 70s. I think two things. The light green shows where private returns exceed public returns, and then the blue is the opposite. I think two things that I'll pull out. One is maybe first of all, is we always get the question when it's light green. So there's always, and apologize, my light just went down, is we always get the questions. We always get the questions when it's light green, is there's uncertainty in the market. And but probably more importantly is you can see there is variation in that. It's not unprecedented what's happening right now as you see that variance, over time. And a lot of that goes to do is, if you look at the next slide, is you can see, and this is over just the past 10 years, where you're looking at a difference in those two returns. We're looking at the dotted line is the dashed line is the NAREIT index, the NAREIT returns on a quarterly basis, and then the other lines, the dark black line there is the return for the Odyssey, NAREIT's Odyssey index. And then that's broken out between, you see the green bar there is the stabilized income return. And then the reddish portion there is the stabilized appreciation return within Odyssey. And so you can see relatively muted appreciation over the, through 2020, much higher appreciation in the Odyssey index in 2021 and early 2022, and then starting over the last 2 quarters, you're starting to see that more of that negative appreciation. And then overlaid there again with the NAREIT returns on a quarterly basis, and you can see much more volatility there, which then translates into what we saw in the prior slide with that gaps over time. So with that, we'll start out with questions to the panelists. And you can take the slide off the screen now. So one is there's always questions during this time on the private valuation side is the appraisal process. Appraisals are somewhat based off of transactions. And so when there's uncertainty, there's the bid-ask spread, not a lot of transactions occurring in the market, so sometimes the thought is, well, if there isn't a transaction, we can't make any change in the appraisal process. So maybe David, if you could start out just as the appraiser on this panel, talk a little bit about the appraisal process, how much transactions come into play in the valuation process, and how that happens, especially how appraisals are conducted, especially during times of uncertainty like that.
Sure. So whether it's an annual or quarterly valuation, I mean, there's a defined methodology we typically go through, and in markets where there's much more uncertainty, we tend to have to reach out to a lot more folks, whether it's on the investment side, brokerage, other market participants, as well as colleagues in the industry, to kind of triangulate where the market's going and what's going on with it. But at the same time, we're still analyzing market and property fundamentals, and then we're looking at everything from tenancy, market leasing assumptions, recent leasing, leasing pipeline reports, default rates on tenants, as well as operating expenses, capital expenditures, and obviously pricing. And that's done on a quarterly basis. Really doesn't matter whether it's a quarterly or annual valuation. The methodology is the same. The presentation may be a bit different, but at the end of the day, it's really, looking top to bottom or bottom to top along the asset, depending on the asset type. I will say that on certain property types and in less dynamic markets, the quarterly valuations become a bit easier because there's just less movement in the industry and what's going on in the market. But generally speaking, the methodology is the same.
And in that valuation process, it isn't just so comparables. Transactions do come into play, but it isn't just that. You have a 10-year, you're forecasting a DCF, 10-year forecast on each of those assets.
Correct.
Talk a little bit about that.
Yeah, it's much more than just rolling cash flow forward, and if there are no sales, hey, we're done. No, it's looking at all the different inputs at a very granular level, and then looking at when that becomes a material impact on value.
Okay, so Robbie, I know just at Altus, you do some valuations in addition to the valuation management oversight, where you not only review but manage the process. But before we get to that, maybe anything to add to what David talked about from the valuation perspective?
Yeah, thanks, Rick. I mean, I wish it's that easy, right? No transaction mean no changes in value. Then if that's the case, we'll be sitting back and drinking Mai Tai by now, right? So, but I guess it's not. Look at our background, it's office spaces, which means we're all still working, right? Working hard on it, right? So, and do a look at as well, like basically, And in this situation right now, we actually had the perfect article for it in PREA 2020. We actually write an article on real estate valuation uncertain time, right? So, and basically, I'll kind of look at it. We dust out that article, right? So, how do we do it, right? So, a lot of cases when there's not a transaction, it's basically re-verifying the sales, right? So, interviewing buyer and seller, right? So, what is a transaction that they did before? How do they underwrite in today's market, right? So, and analyze maybe a prior period. It's a little bit different, right? So because prior period, generally you might have during the downturn, you might have a slower fundamental with changing in pricing. In this case, the fundamental are really strong still, right? So analyze the financing market. It is one of the input, right? So kind of analyzing the sales and a lot of interview, what David indicated, there's a lot more due diligence today than previously, right? So, and public market as well, we look at as a trend, right? So basically, you listen to the earning call, trying to provide good insight to what the macro trend is, what the operating challenges, and what the leasing is, right? So definitely a lot more work today when there's not a lot of transaction than when there's a lot of transactions. It's easier to kind of find the detail, right? So that's on the valuation perspective. On the review side, basically, again, the first step on review to make sure that, for example, when David finished the valuation, right? So on the review form, we want to make sure that the cash flow accurate, right? That's the first step, right? So making sure that the factual are being modeled properly, no mathematical error, kind of recovery are correct, and then kind of look at assumption. How is it consistent with what indicated in the report as well for the cash flows of the report, right? So then finally analyze the conclusion and assumption, right? So is market rent that appraisal indicated, is it supported, right? So how's the recent leasing, right? So is the lease up rate reasonable, right? So how about TNLC, right? So, and afterward, as can we also consider the budget, right? So is the budget capital included, what is being spent, what's not spent? And finally, on the pricing side, right? So is the conclusion from the appraisal CellCom, is it supported? How do they come up to that kind of assumption input? And also look at changes from prior period, from prior quarter, does it make sense or not, right? So, and the other thing as well, basically is in there, it's not just us and appraisal, right? So clients also involved. Basically, we typically get input on client trying to address any material changes with the subject property, right? So any leasing that being negotiated, any tenant that could be not renewing here and there, right? So, and the other thing as well, like a lot of an appraisal are trying to reflect market, right? So getting input from the client as well. The deal that they look at, the deal that they did not bid, or the bid on, trying to understand on the market, any additional input is helpful in today's market. And finally, all this comment are documented in our system, right? So we make sure that there's audit trail in there, we make sure there's check and balances in there. And once the final value finalized, right? So the report is checked, we have to redo again basically on that kind of check, right? So making sure that the assumption tie again, make sure the changes that the indicator is in there, right? So again, it's not just looking at value and finalize, right? So it's a lot more kind of a check and balances, a lot of due diligence, a lot of analysis being done on it.
The other thing I'd point out, sorry, Rick, is just, it's not just that there's a lack of transactions, but we also look at the transactions that failed to transact, because that's an important data point. And while we all recognize there's a bid-ask spread and it could be substantial depending on the asset type, that's definitely a data point we look hard at.
Yeah, and I think what we've seen a lot of clients, especially going through their fourth quarter marks, is maybe they're not putting as much weight on those sales the sales comparison approach as they do typically. It's more of a qualitative discussion around the transactions that maybe didn't transpire in the marketplace, past transactions, where things may have moved since then, why things didn't close, as David just laid out. And use that as a corroborating a set of facts that kind of back an income approach that may get more weighting in times like this than transactions.
That's great, and I think a couple of things that taking out of this is, one is the anecdotal evidence that you guys all mentioned is the deals that don't close, the leases that aren't signed is equally as important as those that are. And then probably most importantly is just the communication. And I think all of you would agree is during times like this is the amount of communication, the amount of discussions you have. There's always discussions with brokers and lenders and leasing agents and everything during the normal appraisal process. But in times like this, it's heightened, where there's much more frequent conversations, much more detailed what's happening in the market, just because there aren't the transactions that are, you don't have actual transactions occurring, which requires more of that communication amongst the industry. One other thing, and maybe to just point out, I'm guessing similar with you, David, you mentioned mentioned 3,000 valuations every year. Robbie, 15,000, every quarter. We're pulling data out of that, looking at it, just looking consistency across markets, across sectors, and making sure and looking at, that what's being reflected in the market, where what normally would be with an actual transaction, now is being reflected across that valuation process to make sure there's consistency. Is that fair comment as well?
Correct. I think it is correct, right? And the other thing as well is the distribution of information, right? So a lot of cases we hear something for one client, right? So I told client this as well. Like a lot of clients only see what's in front of them. We see what in front of a lot of other clients, right? So, and then distribution, get information back to the appraisal is important, right? So a lot of cases we do have kickoff call with appraisal before the appraisal start, right? So, and then during the appraisal as well, there's another call as well with appraisal, right? So a lot of cases, more information is better, right? So because as what we indicated, like an appraisal have to mimic the market, right? So the market, a lot of cases, a lot of client, right? So I know David talked to broker a lot, talked to connect lender a lot as well. Again, communication is key, right? So I think organizationally as well, NACRE, there's a lot of conference call within that as well, right? So again, like in today's market, it's about kind of understanding basically market behavior, right? So how people underwrite in today's market.
Okay, so had third-party appraisal completed, the draft value comes in. Robbie, from a valuation manager perspective, reviewed the valuation assumptions factually and that. Once it goes through the review process and the value's finalized, end of the quarter, end of the year, auditor perspective, Nathan, you come in and Deloitte comes in and looks at it. Talk a little bit about how the audit firm's perspective in the valuation process is and how you look at that.
Right. So, as auditors, what we're really looking at is reasonableness and documentation, and making sure that assumptions and values are backed by some facts and data. So it's looking at methodology, it's looking at consistency, it's looking at controls, the fact that the right inputs are going to the appraisers, things like leases, you're getting the leases with all the right amendments, right? So you fully know what the contractual rent terms are. You're looking at that CapEx and budget, making sure you're getting, what is the latest and greatest from the company. So it's the controls and the process for doing that. It's looking at the methodology and making sure that's consistent quarter over quarter. The fact that, if a market does change a little bit, you can't change really change and go to a wholesale different, methodology or approaches because things in the market are changing. So it's looking at that consistency. And then it's really keeping our ears open for areas of high risk, right? It's having discussions with the client. And ultimately, from an auditor perspective, we do review a sample of appraisals across big portfolios. Obviously, it's not possible to review each and every appraisal in full detail. So it's looking at a sample of assets, whether it's there's a bunch of different factors that the Deloitte, our auditors, use to assess risk and think about where the risk lies, and then hopefully choose a sample that is indicative of the different property types, whether it's size, geography, et cetera, from a risk perspective that then we dig into a little bit deeper as valuation experts as an audit firm. But I think we're really focused on the documentation, that process is very consistent, well documented, and that there is support for certainly and I guess factual support and background for some of the major assumptions that drive those valuations. And in a market like this, where again it's a lot harder to point to, hey, there's this transaction, or hey, there's this fact pattern. I know there's a lot more Q&A for the ones we do dive deeper into with the appraisers or the appraisal managers as well.
Okay, kind of back to that theme of just a lot more discussions, a lot more communication, throughout the process. Excuse me. We are having quite a few questions come in, so I'll kind of bring them in as appropriate. and so one question is, you mentioned talking about the anecdotal evidence and the failed transactions or the deals that didn't close. Question came in is, how do we collect that information? So maybe it's really, I guess, to all of you is who wants to jump in and just how do you collect and look at information on deals that haven't closed?
From my perspective, our client base is pretty proactive in discussing with us transactions, and while one client may be diversifying and divesting an asset, another client might be looking at that asset, and they call, and so it's constantly there's people looking at assets, diversify or divesting of assets, and it really gets back to that communication. I mean, we're on a routine basis, we're talking to most of our major clients, asset managers, acquisition, disposition folks every quarter, and trying to just understand exactly, what they've taken to market, what's transacted, what hasn't transacted, and why.
Yeah, and it's very similar as well in Altus, right? So basically, again, we get it from our client, right? So, and then we distribute it to our team, right? So basically, we have a meeting basically twice a week, right? So during this uncertain time, at one point we have like once every day, right? So right now we kind of back to kind of twice a week, kind of going through every deal out there. The deal did not go through. If the deal go through, what's going on, right? So, and then from any sources as well, right? So it might not be just deal go through. Some cases could be the deal got foreclosed, right? So what's going on, the detail about it as well being dissected, right? So, and that information we dissect, we distribute it, right? So the great part about basically during the shutdown, the technology have improved communication wise, right? So yes, everybody use team, right? So our team kind of channel was pretty active about it, right? So everybody see what it is, and then from then on, we distribute back to our client, we distribute back to the appraisal, right? So again, that's communication, kind of two-way street. We all industry, we all kind of see different things. It's basically how do we distribute it back throughout the industry.
And I would say, obviously confidentiality, issues aside, there's definitely communication among the colleagues in the industry. Rob, you'll say, hey, do you know anything about this transaction? And I may or may not, or vice versa. So there's been a lot more, I guess, ever since probably COVID began. That probably kicked off a lot more discussions amongst industry participants. But it's continued to evolve, and there's constant communication.
Yeah, and client pretty open about it right now as well, right? So it's not like, hey, confidentially, they talk about it. Like, so they indicate what's going on, why they didn't transact, what do they think it is, right? So I think, and if they buy, what do they think is a good buy, right? So they're still all in there, and they talk about the financing market, right? So, and then the other thing as well, the other challenge for us is basically not only analyze the deal, if the deal comes with favorable loan, right? So if it's kind of assumable loan, what does that impact the real estate, right? So again, understanding this, again, the only way we can dissect it if there's information about it, right? So.
Yeah, and I think a lot of the clients we deal with are sophisticated institutional investors, and they're always striving to be best in class at what they do in their process and procedures. So we do have they do reach out a lot of times and say, hey, we want to talk to you about what process do you see others going through in a turbulent market like this, and hey, there's a lot of lack of transactions. What are others doing to kind of get around that? And what are you seeing others do around getting certain types of data, and how are they doing it? And always they want to make sure they're always kind of leading the pack, and being best in class to the extent they can be. So I think there's a lot of that amongst larger clients as well, to make sure they're doing all they could and leveraging all the information and tools and network they have available to them, along the way.
Okay, great. Maybe we'll start. We're going to have a couple of polling questions here. So maybe we can pull up the first poll question is, and so we're going to make everybody on this call appraisers right now. So our real estate values near the bottom. So we'll make it easy. Yes, we're near the bottom, meaning pretty much not much further decline, or no more than 5% further decline. Next one would be we have a way to go, which is 5 to 15% further decline. And then the following one is we aren't even close, and that's indicating more than a 15% further decline. And just to remind you guys, you don't have to be appraisers now, the panelists. You don't get to vote. We'll just look at the responses and take it from there. So we'll probably give it another 5 or 10 seconds or so. And yeah, whenever we have a good response rate in, if we could show the results then. So we have, it looks like overwhelming, or 2/3 are saying we have at least 5 to 15% further decline to go. Less than 5% is about 22%, and then more than 15% is only about 10% of the population. So I would say not too surprising from what we're hearing in the market. Any comments from the panelists on what you're seeing there for responses?
Yeah, I think it's also depend on property type, I would think, right? So now we take a broad-based basis, and then everybody have a different perception. What is a component of that return as well, right? So if you think it's an office, maybe there's more, right? So if you think maybe the industrial and apartment, maybe that's less, right? So it's all depending on what the composition of that of the overall return, right? So.
No, and I would add that it's also very market specific. I mean, a San Francisco or New York is very different from a Dallas, or Houston is different from, a Chicago. So it becomes very market specific as well.
Good. Well, and that's probably a good segue into the next question, is because, as you mentioned, is especially when you're looking at sectors, probably where there's the most uncertainty, because it's not just a pricing question, but it's also a fundamentals question, is with office. By far, the biggest topic when it comes to valuations. So maybe with that, I'll throw it to, let's see, Robbie, you want to talk first, just what you're seeing with office valuations?
Sure. I think that the office valuation, I know the headline news, we might seeing the office only down 10% so far, right? So I think part of it's the component of office within Odyssey, right? So some office value have down significantly, right? So, but it's not being shown, right? So part of it is because of the life science and medical office, right? So just looking at our client database, just data within our client, right? We kind of count about 15 to 20% of that asset is what we consider life science and medical office, right? So I know a lot of them have not fully categorized them yet, but within that category, we saw a lot of the asset, like especially the life science, have a high return over the past 2-3 years, right? So part of it is like a lot of the life science building within Odyssey, a lot of them are conversion, redevelopment, and new development that have a significant return, right? So that gain kind of completely covers some of the loss in community office, right? So, and I think we have presentation on like last week on the Odyssey fourth quarter return. We've shown 5 market already to have more than 20% appreciation, on negative appreciation in the past 3 years, right? So that's include New York City, Chicago, Houston, Washington, D.C., right? So, but most people don't even realize it, that market have down more than 20% in the last 3 years, right? So not saying that there's no pressure on office, right? So back to the office is not fully successful yet, right? So you look at the physical occupancy, still maybe 50-55%, right? So it's less in some market, right? So definitely a big question mark is basically what does the revenue look like when the lease roll, right? So we keep hearing the news about one Vanderbilt, but there's only one Vanderbilt out there, right? So there's only a handful of asset that's kind of one Vanderbilt, right? That's getting $150, $200 per square foot lease, but not a lot of them out there, right? So it's still a big question mark, like how is the office look like? What is the return to office? When the lease roll, what did that look like, right? So definitely there's still happening in the office sector.
And I would just add that on the life science side, the price per pound is pretty high. So, that's an issue as well that affects it.
Yeah, I think office is probably the one sector where we're seeing the most variability across geographies, right? I mean, it's certainly, it's not a one size fits all. It's not something to look at nationally. It's so, certainly you're seeing differences in geography and even differences, a little bit more, Robbie, Dave probably be able to talk about it a little better than me, but even between, the Class A kind of, top-notch product and kind of the, second tier Class B product, seeing slightly different, feel in the market for those assets.
And I think, as you kind of all mentioned, it's especially now, and especially in office, it's kind of like regional malls were 10 years ago. It's the have-nots. It's which markets, not only which markets, which sectors, but also which individual assets as well make a big difference, and especially the amount of capital needed in office to be invested. That does come into play across individual assets.
Say, Rick, is that unlike regional malls where you had a bunch of tenant bankruptcies and you got space back immediately, the office is much more of a slow unwinding as, the leases tend to roll over, on a longer term basis.
Yep. And from a fundamental perspective is the back to office, which I'll point out 100% back return to office in the on the panelists here. And so that obviously will have a play, and especially with the demographics and Great Resignation and how that impacted it. So there's a lot of uncertainty, a lot of questions as to how that all unfolds out coming forward as well. What I'm just kind of looking through the questions here, and one we'll get to interest rates and cap rates and stuff like that in a little bit, but specifically there's a question that I know we've heard quite a bit where looking at longer term leases, so you have maybe it's a single tenant office building and doesn't have to be office, industrial, whatever, is longer term lease, 10, 15 years. How is that being impacted from a pricing perspective when you look at discount rates, exit rates, and just the uncertainty, in the market and adjustments by the Fed and that? Anyone want to take that?
Well, I would say that, if you got a long-term lease and it's below market, and you're not going to be able to execute and capture that, market rent until way out in the future, people are starting to, where historically that was a positive, now it's become a negative, and you're going to increase your yield in order to, maintain a reasonable yield on that investment. I don't know, Robbie, if you have any thoughts.
Yeah, I think that I'll break it down into two categories. I think industrial and office act a little bit differently, right? So I think the office, the same as what David indicated, is unwind later, right? So at least a long-term office, especially leased by a credit tenant, they're still paying, right? So their credit rating is still pretty good. You have time to figure out what's the office space gonna look like, right? So I think that's kind of an office longer term will act better, right? So on the other hand, basically the industrial front, that's the big challenge today, right? So the big question today, especially when the cap rate went so low, right? So how low can you hold this this low yield for, right? So I know there's a lot of kind of people kind of saying that, hey, therefore the cap rate increases. On the other hand as well, depending on what the rent is, so that's the toughest part, right? So if your leases that look past the 10-year period, some adjustment you have to kind of look at it, how the below market versus kind of the market rent and the exit, right? So you have to kind of look at the credit rating for the tenant as well, right? So that's part of that equation. But we all know even the high grade bond, they all move up in yield, right? So therefore there's capital market movement, right? So and that's kind of seem to be the biggest challenge today. I think people understand the shorter term lease industrial is pretty easy to transact, right? So the longer term lease industrial, from our client side, I see bifurcating view, right? So on one hand, they kind of say, I'm getting a credit tenant here for a longer period of time, right? So on the other hand, you're not seeing the appreciation. On the other thing as well to look at, during the 2021, 2022, with market rent increasing, right? So some of these longer term leases did not benefit as much, right? So because they're capturing the back end, right? So now on the other hand, when they move down, the cap rate moving, right? So fundamentals still strong, impacting them more and kind of on the downside, right? So it is a challenge in today's kind of environment. So a lot of communication between client and us as well, trying to what is the right pricing for it, right? So, but for sure, I think that the lower cap rate definitely seeing an increase. We've seen that already the past 2 quarters, right? So that's why some of the market during our presentation, we show a lot of a negative adjustment in inland empire. Part of it's for that reason, right? So the lower cap rate are being moved up.
Yeah, it kind of harkens back to the GFC, where I think the term was or right before the GFC was the term was there was a premium for vacant space. Is the faster when you're looking at spreads between contract and market, the faster market goes up, is the quicker you want to be able to convert to that. So shorter term. So that sounds good. Maybe I'll switch. I know we did want to cover, just again, I brought up about the public versus private discussion and so maybe back to you, David. Any difference when you're looking public versus private, if you're, whether the asset is owned in a public REIT or if it's owned by a private fund? Anything different in the valuation process?
No, the valuation process is basically the same. We ask for the same data. We ask, depending on the property type, same methodology. Again, talking to everybody under the sun in terms of the marketplace. I mean, I would say that, if you pulled up a regional mall we did for, a debt deal and put in the same sphere of a comparable regional mall that we've done on the equity side, the assumptions align. There's really no difference. And the other thing is you're getting another, on the lender side, you're getting different review comments and a different list or, group of people reviewing the reports. But, it's all the same for the most part. I just view
Nathan go ahead.
I was just gonna say, I just view the public markets as very reactionary, and the private markets are more, I guess, deliberate, for lack of a better term.
Okay, maybe Nathan, just I know because you look at both public REITs as well as non-traded REITs and private funds. Your perspective.
Yeah, so I mean, I think from from an auditor perspective, where our auditors are doing right, their job is to audit the GAAP, the GAAP financial statements, which are generally the historical GAAP financial statements. And while some of the actual fair value inputs on like a a non-traded REIT are inputs to those versus how things like fees and commissions are being generated, they're not, that's not part of the historical GAAP audit. I do think there's the certain, that process, the controls, the methodology, all those things of that process are being, being tested and looked at by, by our auditors. They're not kind of, really digging in again and testing each and every one of those fair values. When our audit teams do ultimately select properties or investments that then come to our team within Deloitte to kind of do a review of that mark or that appraisal, we don't look at it any different, whether it's public or private or anything for that matter. Just like David said, we're going to do the same appraisal review, do the same valuation review regardless of who's holding that asset, whether it's debt, whether it's equity, whether it's public or private. Still going through the same process and procedures for doing that when when a fair value appraisal or a mark comes our way.
Okay, so maybe Robbie is, because I know we get this question all the time, is the public versus private GAAP, and that your thoughts and comments on that?
Yeah, I think it's very similar to my previous webinar. I kind of look at it. Private real estate is kind of traded based on NAV, right? So, and public are traded based on share prices, right? So, yes, in today's market, you can argue private valuation might have subjectivity, right? So, on the other hand, public trading, in a lot of cases, also have sentiment and speculation as well, right? So, therefore, public can trade it above and below NAV, right? So, and actually, regarding this differences, I'm doing my shameless plug again, right? So we got a pre-article coming up, right? So this Friday, discussing the same topic, right? So the difference of basically public versus private, like so. Generally, as well, that private real estate, it is much more bottoms-up approach, asset by asset, right? So to get to the NAV, we have to value the asset, right? Free and clear, right? So an asset by asset basis. Then you layer in the value of the liability, right? So the fair value liability. So therefore, you have to kind of look at it, the asset value. Then you look at liability, how's the comparable loan today, right? So to come up to the fair value of the liability. Then you take all of that input, then you put it to waterfall calculation, right? So basically, to come out to the joint venture, taking into account the joint venture interest portion, right? So trying to reflect the ownership share of that asset, right? So so again, much more like what David Walden delivered, and also kind of methodical as well, right? So in each aspect are being put into this calculation, right? So then in the public side, it's much more about multiple, right? So you cannot really do bottom-up approach kind of to determine public REIT, because if you look at public filing, you don't have an actual rent roll, right? So you don't have an expenses and asset level. It is not treating based on NAV as well. Do I look at it is two different vehicle, right? So for different purposes, right? So it's both on real estate, it's just a different vehicle.
Okay, good. Maybe we'll do another poll question, and then I have one or two more questions for you, and then we'll address some of the questions that are coming in, which are quite a few. So one is, so we talked about office, and obviously most uncertainty, value uncertainty with office sector is where if you set the office aside, is what other sector do you see as having the next most value uncertainty or value challenges on a go-forward basis? Is it retail? Is it apartment or multifamily, industrial, or is it one of the other sectors or subsectors? So we'll give it another few seconds to get everyone's response there. I think this might be down to specific markets by sector, but we'll see what the audience thinks overall. So if we want to go ahead and show the results. So it looks like retail. Yeah, that's maybe a little surprising. I guess I'll ask the experts here. David, I know you're big in retail. Would you agree with that response?
I mean, it's a tough call because, you know, I do think that retail's been pretty hammered over the last, you know, half dozen years. So, but it is very much a question of the has and have-nots, whether it's either, you know, regional malls, whether it's grocery anchored shopping centers and who the anchor is, you know, so it's very bifurcated. So I don't know, I would not have said retail, but I'm not sure what I would say, so.
Yeah, but I always said retail actually. So because again, I'm kind of looking at basically one, it tied to the sales, right? So it did discretionary spending to some extent, right? So if it slow down, it could be retail. The other thing as well, on the mall side, there's a lot of redevelopment, right? So with financing kind of being tough to get, right? So big uncertainty in there, it's hard to pencil as well, right? So I think that's kind of part of it as well. So I think I can see retail being kind of in a sense the most uncertain after the other one. So I think some grocery center retail with long-term lease in there, you feel relatively fine, but some other retail may be a little bit more challenging.
Yeah, I would agree. I follow with Robbie. I think it's probably been in the news maybe a little more than some others, right? Maybe that's why, you know, it was voted up here. You know, but there's definitely the haves and have-nots there as well. You know, some of the good grocery anchor product, not a lot of uncertainty there, right? So.
Well, and I guess thinking out loud, I mean, there is the high street retail, and you know,
that's true. High street retail, big question mark still.
Big question mark, yes.
And it might be a process of by elimination as well, is given we're underhoused as a country, given just such a significant demand for logistics, that if you back those two out, you're kind of left with retail being the questions as well. Maybe one more question, and then I'll try and do kind of rapid fire just some of the questions that are coming through, and I'm trying to group them together a little bit. But maybe just in some of these questions is, tell me the relationship between interest rate changes and cap rates. So 50 basis point move by the Fed or 50 basis point move by the 10-year Treasury. What does that do to the underlying assumptions, whether it's discount rate, exit rate, or a cap rate?
Yeah, on that one, Rick, I think there's definitely impact. There's a lot of analysis being done, but it's not one-to-one correlation. That's the reality of it, right? So if you look at our last, I keep pointing to our last week webinar, which is available on recording as well, right? So the discount and exit cap rate, for example, the past year for the Odyssey have moved up about 50 basis point on discount rate and 30 basis point kind of on the exit, right? So, but you look at the value did not drop as much. Part of it is fundamental still strong, right? So, and then the other misconception that a lot of people get confused a little bit as well, they're trying to understand, oh, this thing moved up, but why your cap rate did not move up as much, right? So part of it is a fundamental piece, right? So we kind of look at cap rate plus gross rate equal discount rate, right? So the discount rate moved, but the other thing as well, the fundamental, for example, like an Odyssey, a lot of cases, 70% of it is all kind of called multifamily industrial. There's a lot of industrial out there with kind of basically low rent. As the rent continue to move, yes, you might move the discount rate, but your cash flow move as well. So that value did not move as much. So your NOI increases did not move as much. But in reality, you do move the discount rate and exit, right? So I think a lot of people just purely looking at kind of in the cap rate perspective, and they're kind of questioning why the cap rate did not move as much, right? So I think that's kind of part of it as well. So,
And I would definitely add, it's not linear by any means. And, we're also looking at, 10-year treasuries, they came in. It's not so much just, the fact that the rates went up. I mean, treasuries came in, I don't know what, 50 basis points for a while there, and now they're probably back up another quarter point. So, it's another data point and another input that we consider.
Yep, and I think it's not only is it now with rates going up, but then it was the other way, as well. When rates were going down, it wasn't linear. The result was that. Right?
We didn't go down as much as well. I think that's one of a lot of people question, right? So hey, now the rate have moved down on 10-year treasury. Should the value move up? So I call it time out real quick, right? So I think that part of it is when the rate moved down, the cap rate did not move down as much, right? So, and when the rate moved up, the cap rate did not move up as much as well. So that's how I kind of look at it. So, but yeah, it is, we have to reflect in a sense, market sentiment and not market sentiment, how people underwrite the deal, right? So some cases, if you look at mid last year, a lot of the deals being transacted are all cash buyer, right? So at that time, a lot of the cases that the financing already higher than what the cap rate or discount rate people buying, and they're still transacting, even continue until the late last year, right? So there's a lot of transaction I indicated already. That's like industrial, like 3.8 cap rate, low 4 cap rate in the West Coast, right? So a lot of cases, and at that point in time, it doesn't seem to make sense compared to the financing rate. But again, like in the private real estate, you can always buy it, you can hold it, right? So, and then you can decide when to refi them later on, right? So it doesn't have to be, or you have to do it at that point in time.
And I think just back to comment with just not being, it's not linear and it's not immediate, as well, is where back to the public versus private is we're on the public side, back to just some of that market sentiment is when you see that change, it's much more likely to be reflected almost immediately and more linear or even more. And it kind of goes back to if you look at just some of the movement of the REITs over the past year or so is over a 2-month period, it was pretty common for 20, 30, 40% moves up and then down and up, based on responses to whether it's the Fed or whether it's to interest rates and that, adjustments there. There's several in here that are directed to individually, so I've kind of picked one out for each of you, maybe starting with you, Nathan. The question here is, do auditors apply fairly standard or generic thresholds for materiality, or does that flex depending on investor type, asset type, evolving macro? So do you adjust your materiality ranges over time or across sectors or across industries?
Yeah, no, I mean, every client, depending on, the size of the audit, the entity that's being looked at, the size of, the balance sheet and where it's going, the materiality thresholds are, are adjusted for each and every, individual client circumstance, et cetera. So that's definitely not a one size fits all component, of the Deloitte audit procedure, certainly when we work with our audit teams.
Okay. David, here's one for you, but Robbie and actually Nathan, you guys do valuations as well, so you could all comment on this. But thoughts on appraisers using the discount rate as a catch-all to solve for value when there's limited trades? So you might say the Ragu discount rate, don't worry, it's in there. Thoughts on that, or just maybe just the? Yeah, go ahead.
I vehemently disagree with that methodology.
Yeah, it is. If that's the case, right, then every pricing is similar, right? So, but it is not the case, right? So,
and if that were the case, we should do direct caps and call it a day.
Even red cap are all same cap rate then, right? So, but again, I think the whole thing it is very asset specific. And the other thing as well, I kind of noted, right? So previously, a lot of the fund performance are tend to be in allocation, right? So when you own asset, industrial, inland empire always win up most of the time, right? So going forward, when the gap of kind of that return become closer, it will be much more property specific. Will be much more selection, right? So there's differences on credit, like the term, right? So same as kind of what we discussed before as well. The property type, location, and again, I think that if you retail, your trade area, right? So definitely a lot more kind of analysis like done, right? So it's very property specific. It's not like one discount rate catch all, right? So.
Yeah, and I think that's one of the factors that I think when we see different appraisers or clients try to mark that and substantiate that from a assumption perspective, there's a lot of qualitative factors that go into that, right? Are some quantitative factors as well, things like credit rating and is the rent above or below market, how long is the term, right? But then there's a lot of other qualitative things too. So it's really trying to understand all those and then think about that discount rate with that lens, which is always a little more challenging than something like pointing to a market rent and saying, hey, I have five rent comps that are between $20 and $22. Like, it's pretty easy, but the discount rate's always a little more of a mix of both quantitative and qualitative factors.
Well, and just back to some of where we talked about benchmarking or looking at other valuations, and that is, it isn't just discount rate or even exit rate. It's that we're looking at for I wouldn't say parity, but just can you explain any variances or differences? Is there's a whole host of metrics looking at, and it's not it's discount rate, exit rate, it's market rent growth, it's occupancy or vacancy assumptions, a whole bunch of other metrics that are really focused on it. Isn't just the discount rate. And that kind of ties into the next question. It took me a little bit to find it again, but I'll address this to you, Robbie. Is there a large variance or standard deviation in valuation metrics across the Odyssey? So now, and maybe if I interpret it right, do you see a lot bigger variance in those assumptions now in a time of uncertainty versus before?
It is. I think that the variance is kind of two-pronged as well, right? So people kind of look at it on the cap rate perspective. You have to kind of look at discount rate and exit. There definitely variations in there, right? So industrial and basically apartment are basically what people prefer, right? So, and the other thing as well is the cash flow assumption, right? So that's the one that people don't see a lot of cases, right? So what a lot of cash flow assumption on apartment industrial, you see kind of continue move up generally, right? So, but in office, that's basically being knocked down like a lot more, right? So the face rent might be kind of similar, but that's a lot, the net effective rent are not, right? So TI are way higher today than before, right? So the lease up, before people kind of look at what is usually lease up 1 to 2 years, some of the lease up is like 6 years, right? So, and then your stabilized vacancy, right? So I think it is kind of what you indicated, right? Like office is the new mall, right? So the same as not like the mall before you incorporate kind of like a static vacancy, that's become more a question mark. They might not model them as a static vacancy, but they model them as a higher general vacancy. So that's coming in there as well. And you're coupling the higher expenses, right? So because in the office, that's kind of a high cost to maintain, right? So with the labor costs, insurance, that's also higher as well. So office are basically being impacted, right? So but you don't necessarily see it on what in the headline news out there, right? So there's definitely differences on various different types, right? So it's all about basically investor demand.
I would just say the assumptions tend to like morph over time. I mean, initially, like when COVID happened, maybe the discount rate was the first thing you did because everyone was uncertain about everything. But as time goes on and people become more and more certain about, here's the direction of this asset class, then you start looking at, like Robbie said, whether it's, renewal probabilities, higher static vacancy, higher general vacancy. I think generally speaking right now, most tenants for the most part are downsizing some form or fashion. So is it really appropriate to be using a 70% renewal probability? Probably not, because that percentage is probably correct, but at the same time, they're going to be taking up less space. So you need to consider that in your cash flow as well.
and I think this kind of goes back to is just, compared to prior cycles, is a lot more data available. I know we can look at the specific asset and look at occupancy over the past 5, 10, 15, even 20 years. And, one of the things to look at is if in the best of times, that building, back to, down to the specific property, if that building never reached above 90% occupancy, it's not likely during this time and going forward with the challenges of remote work and that, it's not likely to achieve that level of occupancy as well. So all of that helps with that as well. And so I think the question is answered, but someone asked, what are the adjustments being made for lower occupancy related to remote workers? Anything to add? You mentioned static vacancy, things like that, more general for
higher general vacancy, lower renewable probabilities, higher downtime, longer lease-up periods, like Robbie said.
Okay. What about from a concession perspective or TIs, improvements into the building, more common areas, more amenities, much more amenitized focus with office buildings?
Exactly.
Yep. Yeah. Higher TI and higher capital, right? So the landlord capital as well, as you kind of indicated, right? So the tenant the tenant have to redesign the space as well, like a lot of cases, right? So you have a lot more meeting spaces, like just look at our space in Toronto, right? They're now the different lunchroom, right? So compared to before, a lot more meeting room rather than just cubicle, right? So definitely need a lot more collaboration room than before, right? So as just remote working, when people come back, you want to collaborate, right? So definitely on tenant side, they will require high TI for them to renew. On the landlord side as well, they have to change as well, right? So there's the different amenities needed, like compared to previously, right? So,
interesting question here is, and maybe just a quick, and then I want one final question from all of you. But are we seeing more CPIs in leases? Is this an indication of strength? Is it an indication of inflation? And maybe this is probably tied more specifically to office, but could be retail, industrial as well.
I mean, we've been seeing some of it in industrial. I would say not so much in office.
Agree.
Yep.
Okay.
Agree there.
Yeah, it is in industrial, right? So because industrials, you look at it, the landlord to some extent have some still power, right? So if you look at the general vacancy nationwide, it's 3.9%, right? So some of the coastal markets still 2%. That's virtually occupied, right? So some of the markets, like only the bad spaces that's still left, right? That no one typically will take, right? So there's always that obsolete space out there, right? So that's where that landlord still, hey, if you want that space, you kind of incorporate CPI, you incorporate higher, rather than 3%, 4%, 5% annual step, right? So they're definitely be seeing that kind of leases, typically industrial spaces.
So maybe back to, and this ties to the question is, no in office and yes in industrial. So maybe it is a sign of strength or not strength in the office market, and so that does reflect that. Maybe a quick question and kind of maybe hopefully ending on a more positive note is with commercial real estate as an investment, as an asset class, what are some of the positive aspects of commercial real estate do you see just in terms of relative to other asset classes?
I'll give it to Nathan first. I mean, typically.
Yeah, I mean, I think our clients are looking for investments right across the entire spectrum. And, I think some of the real estate assets that we've talked about here today, right, you have the ability to lock in, forecast and income that what it's going to be, to the extent you have, things like industrial assets, leased grocery anchored retail, office with good long-term leases. I mean, you have steady income that you could forecast out 5-10 years, which, something from an investment perspective is a positive, any way you look at it.
David?
I would echo that, just the stability of, cash flow, assuming you pick the right assets in the right markets.
Yeah, and on my end, Rick, I think they'll look at the fundamentals still, excluding office aside. We can talk about it all day long already, right? So, but generally, I look at excluding office aside, the fundamentals are strong still, right? So we talk about industrial, an apartment, the same thing. Like there's lack of housing, 2 to 8 million, depending on what report you have, right? So inflation, which means construction costs expensive, financing issue, which means the new development is going to be more difficult, right? So yes, you have some near-term supply in some market, but once you pass through that situation, that basically near-term or mid-term basis, that still really look positive, right? So being out this as well, we see a lot of new fund out there. We see a lot of fund. We also see a lot of new fund being created, right? So yes, they might not buy tomorrow, but at least that fund formation is in there. The dry powder is building up, right? So that's definitely a lot of positive sign to real estate.
Okay, and you kind of mentioned, but I think just, maybe not immediate, but more longer term, the inflation, component. Everybody has a different idea as to where, inflation is or will be, but that's obviously a positive with commercial real estate as well. So we're at the top of the hour. First of all, I want to thank, Nathan and David and Robbie. I want to thank you for participating in this. I think this is very helpful. I know we get a lot of questions on valuation. I know a ton of more questions, we'll try and get back to, but back to everyone, we appreciate you joining, as an attendee. If you find this valuable, please let us know. We want more transparency, more communication as to what's happening out there, especially back to the theme of more communication during times of uncertainty is just helpful, more transparency. As Robbie mentioned, he and Phil Tiley have a quarterly call just talking about his returns and unpacking that. And then also, as Robbie mentioned, is we have another update coming out in the winter quarterly for PREA, and I believe Friday or early next week that'll be available to the public as well. So thank you, everyone. Thank you, David, Nathan, and Robbie, and we'll talk to you again next time. Thanks.
Thanks for having me. Thank you.